As the markets have closed for the weekend, Strategy Inc. Class A finished Friday's session at $351.63, marking a very subtle decline of 70 cents or just 0.20%. On the surface, this figure is the very definition of unremarkable. It's the kind of fractional movement that suggests a quiet day, a placeholder session where nothing of consequence occurred for a supposedly stable blue-chip name. This is the common perception, the market narrative that paints Strategy Inc. as a predictable, slow-moving giant. But that placid surface is profoundly misleading. The reality hidden in the trading data tells a story of immense coiled tension. In the final 30 minutes of trading, a colossal block trade, representing nearly 1.5% of the company's publicly traded float, was executed in near total silence. This wasn't a series of small retail trades. It was a single, anonymous transaction that suggests a major institutional player is making a decisive move. The stock price barely flinched, but the sheer volume that passed hands under the radar indicates that behind the curtain, a high-stakes game is unfolding. The expectation is stability. The reality is a silent, brewing storm that could define the company's trajectory for the next several quarters. This discrepancy between perception and underlying activity is where seasoned investors find their edge. Many who are engaged in online investing, perhaps using a platform like SoFi Invest for its blend of active and passive options, might see Strategy Inc. as a core holding within a diversified portfolio, a bedrock of stability against the volatility of names like Tesla stock or Nvidia stock. The minimal daily change would reinforce that belief. However, the professional traders, those utilizing the deep analytics of a service like Interactive Brokers, are likely flagging that massive end-of-day volume spike. They aren't looking at the 0.20% dip. They're analyzing the order flow, trying to decipher if this was an accumulation by a fund that believes the stock is deeply undervalued, or a quiet distribution by a long-term holder who sees trouble on the horizon. This is the kind of detail that automated systems like Schwab Intelligent Portfolios might not immediately react to, as their algorithms are often weighted towards broader market trends and fundamental data, rather than single-session trading anomalies. For those looking for investment help, the key takeaway is that the most important market signals are often the ones that don't make the headlines. The quiet price action is, in this case, a mask. For weeks, the stock has been trapped in a notoriously tight trading range, frustrating both bulls and bears. This consolidation period has led to a buildup of energy, and that large, silent transaction could be the first tremor before a significant price earthquake. To truly understand the forces at play, we need to look at what Strategy Inc. actually does. The company built its formidable reputation over decades as a premier management consulting firm, the go-to advisor for Fortune 500 companies navigating complex corporate transformations. This traditional business model is cash-rich and prestigious, but it's also linear. Its growth is tied directly to billable hours and the number of partners it can employ. This is the company most investors believe they are buying into. However, the reality of Strategy Inc.'s current operations is vastly different. Over the past 3 years, the firm has poured an immense amount of capital into developing a proprietary, AI-driven software platform named Nexus. This platform is designed to automate the strategic analysis that was once the exclusive domain of its human consultants. It ingests vast amounts of market data, internal company metrics, and macroeconomic trends to generate actionable strategic roadmaps for corporations. The expectation is that this is a side project, an internal tool to augment their existing services. The reality is that the company's leadership sees Nexus as the future, a transition from a service-based business to a high-margin, scalable software as a service (SaaS). This pivot is a monumental gamble. If it succeeds, the company could be revalued on a software multiple, which could send the stock soaring. If it fails, the immense research and development costs could cripple its profitability for years to come. The latest earnings report was a perfect illustration of this internal conflict. Revenue from the legacy consulting business was solid, beating analyst expectations and showing resilient demand for their expert services. This is what comforted the market and kept the stock from falling. However, the earnings per share figure came in just shy of estimates. The reason for the miss was a significant increase in capital expenditure. All of it funneled directly into the Nexus platform's development and marketing. This is the crux of the matter for anyone considering this for their individual brokerage account. Are you investing in a stable, profitable consulting firm, or are you funding a high-risk tech venture? Investors using Fidelity Wealth Management, known for its long-term, fundamentals-based approach, are likely debating this very point. The Fidelity mobile app would show the solid revenue figures, but the deeper research available on the Fidelity trading platform would highlight the growing R&D burn rate. This dual identity makes Strategy Inc. a particularly complex asset to evaluate. It's not a pure-play tech stock like Apple stock, nor is it a pure industrial or service company. It exists in a liminal space, and the market is struggling to price in the enormous risk and potential reward of its transformation. This brings us to a critical question for every investor watching this company. Comment below with your take. Should Strategy Inc. spin off its Nexus software division into a separate company, or should it keep it integrated and risk the entire firm on this single ambitious pivot? The divergence in how different platforms and their users approach this stock is fascinating. On an app like Robinhood, where the focus is often on high-growth, high-publicity names, Strategy Inc. barely registers. The lack of dramatic price swings and headline-grabbing news makes it unappealing for many retail traders using the Robinhood app for its simplicity and access to fractional shares. Conversely, the more sophisticated clientele at Interactive Brokers are likely modeling complex scenarios. They're examining the potential market size for strategic AI software, the competitive landscape, and the execution risk. The low Interactive Brokers fees on large trades would certainly be attractive to the institutional fund that executed that massive block trade on Friday. Meanwhile, investors on platforms like SoFi, which cater to a broad demographic from beginners to experienced traders, are getting a mixed picture. The SoFi robo-advisor might allocate a small portion to the stock for its historical stability, while those using the SoFi active investing platform are likely waiting for a breakout from the current trading range before committing capital. The tools for online investment have democratized access to the markets, but they haven't simplified the core challenge of accurately assessing a company in the midst of a profound identity crisis. Fidelity Investments, with its vast library of research and mutual funds, likely has analysts dedicated to dissecting every facet of this company, with some Fidelity ETFs potentially holding it for its consulting side stability, while others might be avoiding it due to the tech side uncertainty. Looking ahead, the future of Strategy Inc. hinges on two possible divergent paths. The bullish scenario, the one that reality could deliver to exceed all expectations, is that the Nexus platform is a resounding success. If the company can successfully sign on even a fraction of its existing customers to this new recurring revenue model, the financial implications would be staggering. A successful transition would see Wall Street reclassify it from a consulting firm to a SaaS powerhouse. In this scenario, the current stock price of around $351 would look incredibly cheap in hindsight. The catalysts to watch for would be announcements of major enterprise clients adopting the Nexus platform, or an earnings report where the software revenue growth dramatically outpaces the legacy business. This is the outcome that the fund accumulating may be betting on. They see the temporary earnings drag from R&D as a necessary investment for exponential future growth. They understand that true self-investing requires looking beyond the current quarter's numbers and seeing the long-term potential. This is what separates a successful investment from a simple trade. However, there is an equally plausible and far more bearish scenario where reality falls painfully short of the ambitious vision. The risks are substantial. First, there's execution risk. Strategy Inc. is a consulting firm at its core. It does not have the institutional DNA of a software development company. The Nexus platform could be plagued with bugs, security vulnerabilities, or simply fail to deliver the promised insights, leading to a damaged reputation. Second, there's market risk. The company's high-paying clients may not want an AI solution. They pay for the prestige and human